Hey there, speculators. It is Rod, TDG, Trader Dev Group. Welcome back to Everything Options. In this lesson, I'm going to talk about risk management. We keep risk management for options trading pretty simple, whether we are selling premium or buying premium. So that's what we're going to talk about in this particular video, and I'm going to give an example from a trade I did actually today while making this video, and I get a lot of questions still on how to where's the stop loss on options. So that's what we're going to talk about. Before I get going, just want to remind you that wherever you're watching this video, if you happen to be watching in a public place like YouTube or anything, doesn't matter, that it's for educational purposes only. You can pause the video right here to read more about risk disclosures and disclaimers for Zero Door Capital and for Traders Dev Group. Okay, so what I wanted to talk about is basically the same concept that I've reinforced in other videos here in Everything Options and the course and throughout basically all of our teaching and training when it comes to trading options, whether we're trading options on ETFs, equities, currency contracts, or even on futures, specifically the new micro futures that we're trading. The example I'm going to use tonight, though, is on a QQQ, an ETF. We trade this very often, and the question that we get asked all the time is, again, how to manage the risk. Okay, so let me first give you the trade that we're going to be using in this example. It is right here. It is a short QQQ bear call spread. Again, this video is not to describe spreads or directional spreads or bear call spreads or whatever, but essentially when you're selling call spreads, that is a bearish position. You're looking for the market to hold the level where you're short a strike or go down. So this is a QQQ bear call spread, and also wanted to emphasize that always the case here at TDG Traders Dev Group, we're talking about an entry that's based on a signal from one of our strategies. In this case, it is an extreme turn sell on a 2-hour at a symmetrical double top. At the time of making this video, the Qs as well as the markets are hitting all-time highs all the time, and this is our sell signal here. So looking for the market to reverse or hold this level, that is why we got into this particular trade. But for this video, we're going to be talking about, again, how we're going to manage risk or what our stop loss is when we are trading an option. So it is a QQQ bear call spread. It's a 297.5 302. Okay, that's a $5 wide strike, and the theoretical max loss is the difference between the credit we bring in and the distance between the strikes. So it's a 180 credit, so your theoretical max loss would be $3.20. Let me bring up the calculator. Okay, so again, you have $5 wide strike and you brought in 180, okay, as a credit. If the market was to move through your protective stop on the upside, in this case 302.50, you would be risking $3.20. Okay, you brought in $1, $1.80, 5 minus $1.80 is $3.20. That's not how we manage our risk. Okay, the way we are going to manage our risk, so here's the position right here, by the way, just bringing it up right here. It is short the 297.5, long the 302.5, creating our bear call spread, and right down here the midpoint's about $1.80. I sold it already for $1.80. So here's how we manage risk and where our stop losses are, whether we are short premium in this case or whether we're long premium. So let's say we bought something for $1.80. In this case, we got a credit for $1.80. In every instance, almost all instances, where did my calculator go? Lost my calculator. I closed it, I guess. Hold on, let me bring it back up. Okay. All right. So in every instance, our risk, our appropriate risk, is going to be 50% of the premium paid or 50% of the premium received. So in this case, let's talk about a credit. It's $1.80. Okay, we're going to take $1.80 times 0.5, keep it pretty simple, and that's 0.9 or 90 cents. Okay. Now in this case, we are short. So all we're going to do is, in other words, we brought in $1.80 in premium. $180 per contract is the most we can stand to make. Okay, if we did not manage this option at all, $3.20 is the most we stand to lose. Okay, however, here's what we're going to do. We're going to take the 90 cents, we're going to add it to $1.80, and we're going to say, basically, if we see the midpoint of that option at $2.70 or higher, we're going to close it for a loss. And what would we lose? We would lose 90 cents. Okay, we would lose 90 cents. I'm not going to talk about targets or how we manage winners. Today is just about stop losses and how we manage risk. Okay, so that's $2.70. That's not the same as the 320, which would be $1.80 plus 320. Okay, we would be essentially closing it out for $5 when we only brought in $1.80. So this case, it's 50% of the premium. So we would close this if we saw basically the midpoint of this at $2.70. Okay, now that is a heck of a lot easier than sitting here and using the entry logic or the price of the underlying, the QQQs, to determine where our stop is. Okay, you could say, hey, if the stock went above 300, I'm then going to go in and close the option at market. It's very difficult to do that, to use the actual chart of the underlying basically ever once you're in a trade, because this is only one dimensional, it's just price, whereas options have 4 different dimensions to them. They have all the Greeks essentially going on. All right, so just to recap, rehash tonight, and I'll do a little post-production where I put this up here. Our risk when we are trading options, whether we are short premium, in other words bringing in a credit, as in the case of the example I'm using here, or whether we are long, let's say we had bought an option for $1.80, in this case $180 per contract. If the price of that option were to decline to 90 cents, 50% of the premium received, we would be out. That's our stop loss. Okay. The other question we get a lot is whether you put that stop loss in. I do never ever do that. You can in most brokerage platforms now, you can run stops even with options, but I just don't do that. I'm going to manage these positions and watch them pretty carefully. I'm a day trader. I'm watching the markets all the time. So for me, I do not do that. You certainly could do that, but you'll see that you can get some weird fills and weird things dinking you out. And there are some other considerations. This is a guideline. It's not a 100% hard, fast rule. There will be times where I give myself a little bit more wiggle room. And the final component is that this is basically 50% of the total trade. If you choose to scale in, scale out, you want to take your cost basis on the entire trade. Now, adding to positions, whether they're profitable or unprofitable, is a story for another day, not today. We want to just take 50% of the premium received or 50% of the premium paid and use that as our mental stop loss in the market. Hopefully that makes sense. And again, on this particular trade here, where is it? Right here. Let me give you one other example, because it's a trade that we just took off profitably. This was a IWM bear call spread, the same as this QQQ that we put on. It was for a credit of $2.10. Okay, now here's our little test. What would our stop loss be on a short call spread if we brought in $2.10 in premium? 315. Right? About $1.05, half of the value of the credit we brought in. If we see that it's going to cost us $3.15 to get out of that position, we're done with that particular position. Now here, the very next day, I was able to close this for $1.70 for a quick scalp of 40 cents. So that position was closed. Now we're not talking about targets in this particular video. All right, but again, let's grab the calculator. I'm not going to grab the calculator. $2.10 credit times 0.5, $1.05, add that to the credit received, $3.15. If that is where the offer is, or the midpoint, you got to close that sucker. You take your $1.05 loss on that contract and you move on to the next trade. Hopefully this was helpful. Let's ride with TDG. Hope you're enjoying the everything options. Many of these lessons might just exist outside of the actual course themselves, so you could have seen this in a lot of different places. We'll see you at the next video. Trade like you mean it. Thanks.